Hi, everybody, and welcome back to video number 3 in chapter 20. And when we left off, we were looking at budgeted cash receipts from sales. So here, we're going to get our cash receipts in two different ways. Some of it is going to be received in cash, but some of it is going to be accounts receivable, which we will not get for probably a month or more after that. So we have to account for that from the standpoint of cash. So here in September, we're getting, or October, I should say, here we're getting 60,000 of sales, but how do we collect it in cash? We get 40% of that 60,000 in the current month. But we've collected 60% of the prior month here in October. So that gives us our total cash receipts for October of 49,900. Same thing in November. We're going to get 40% of November's sales in November, but we're going to get the remaining 60% of October's sales in November, and that will give us 55,000, etc. So as you can see, cash sales are 40% of each month's sales. Accounts receivable balance at the end of each month is 60% of that month's budgeted sales. The end of each month. Okay. So prior month, essentially. All right. So here we're looking at the sales, and now the schedule of cash receipts now. Those that we collected from accounts receivable, those are going to be, we're going to collect 80% from one period ago, and the remaining 15% from two periods ago. And the difference there, as you can see, that's 95%. That's saying that we're not going to collect all of that, and we're going to lose some of that for people not paying us. Okay, everybody see that? So now if we look at cash payments for direct materials, here we have our materials purchases, but this time we get a little break because we're purchasing this from our vendors. So we're not going to pay those vendors in the current period. We're going to pay them in the next period. So here is our materials purchases, and we're going to pay that in the next period. See, September is paid in October, October is paid in November, and November is paid in December. So that's going to dictate our cash payments. Now, over several periods, we might say, hey, we're not going to pay, we're only going to pay for 20% of October. Let's make sure that they've done that right. 10,240 times 0.2. Yeah, they're saying in the current period, we're going to take 10,240 times 20%. But we're not going to pay 80%. 80% of our September sales, we're going to pay, let me make sure that's right, 5648 times 0.8, 4580, oops. 7060 times 0.8, yeah, 5648. So I'm taking 80% of 7060 to get to 5648 here. And that's how I'm going to pay based on several periods. So we have cash payments, and can be a little tricky. All right, so at the end of all this, we need to prepare that cash budget. And we have beginning cash balances here. And we're going to add the cash receipts that we've previously calculated. And that gives us the total cash that we have available here. And then we have cash payments. We have them for direct materials, direct labor, variable overhead, sales commission, sales salaries, etc., all the way down. Now, and of course, our income taxes. Now, and dividends every quarter or something like that. Now, the interest on the loan, we had $10,000 outstanding as our loan balance. So we take 1% of that, that's about 12%, and that's going to give us interest of $100. Now, we'll add that to the cash out, and our total cash payments $43,565. So our preliminary cash balance $25,635. We are now over our minimum by $5,000. We want to keep a minimum of $20,000 as safety, right? A minimum. So we're $5,635 over that. So we don't need any additional loan. We can repay down to $20,000, which is $5,635. And that changes that $10,000 loan balance down to $4,365. And so now you'll see here that's 1% of the 4365. That's our interest for that. So away we go with November, same kind of thing. Throw in another $44 for interest and $3,000 for dividends. That kicks us up to $31,954 cash balance. So our preliminary cash balance is nice now. We've got $43,246. We've got plenty of room now to repay the entire loan balance of $4365. And that leaves us an ending cash balance of $38,881 with no loan balance at the end of the month. And that ending cash balance for November rolls up to beginning cash balance for December. And we roll through the same process. Not to forget the $25,000 here for the purchase of that in the capital expenditures budget. Okay, you can see that cash budget is, although very simple in this particular example, it's not that easy in the real world to do this properly. It takes a lot of practice and knowledge of what you're learning in this chapter. Okay, next, loan activity. I think we already kind of went through that, but here the cash that we paid is based on 1% of the ending loan balance. So we had interest cost here of $144 here for $4365, and then at the end of November we didn't have any because we paid off that loan. All right, budgeted financial statements. Here we start off with the income statement, and these are, based on for the 3 months ended December 31st. This is a budget, right? Not an actual. So we have our sales for 3 months now. We have our cost of goods sold for 3 months, our gross profit, and our selling, general, and administrative operating expenses, sales commissions, sales salaries, administrative salaries, and interest expense. That was the $100 plus the $44 for the first 2 months. And that gives us operating expenses of $38,000, and eventually we pay some taxes on that at 40%, and that gives us net income of $59,254. All the information in the budgeted income statement is taken from those, I call them subordinate budgets, that we've gone through in the previous slide. income tax expense, the assumption was 40% of budgeted pre-tax income or income before tax. Okay, now we have a balance sheet. Here we can pick off that cash, 44,706. If I come back here, our ending cash balance was 44,706. So you can see easily where we get that, and the accounts receivable, raw materials inventory, all of this comes from the budgeted financial statements. Now I'm going to show you something. Notice here, if I haven't stated so far, these speaker notes down here can give you some hints when you're studying this as to what's going on down here. So I just want to be sure you realize that there's some, in addition to my commentary, there's also some other commentary that you can look at while you're studying. Okay. Now, we'll take a look at budgeting for service companies. For service companies, the service providers also use these master budgets, but they need fewer operating budgets because they don't have the degree of complexity that a manufacturer would. So all they're talking about here is their sales, their direct labor, occasional capital expenditures, of course, and SG&A expenses here, and a cash budget. Oops. All right. And they call that cash budget a financing budget. And they call the capital expenditures an investing budget. Everything else is an operating budget. All right, a direct labor budget for a service firm. And let's look at that. Here we have our budgeted direct labor cost. We have our budgeted direct labor hours and our budgeted direct labor cost per hour. And we can foot that all out nicely into our direct labor cost. Here they've done just that. They put the hours in here. They put the cost per hour here and just multiplied it through. Pretty easy. The revenue per employee is pretty interesting for a huge company like this. Here, this was Microsoft. So Microsoft has 131,000 employees, and Hewlett-Packard has about half of that. Nevertheless, the revenue per employee, we can take the total revenue and divide it through by the number of employees. Pretty straightforward, I think. All right. Each component of the manufacturing master budget for a merchandising company. Now, this is Appendix A in your book. This is probably a good place for us to stop this particular video. And when we come back, we'll take a look at that merchandiser's master budgeting process. Until that time, bye for now.